Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so excited about my new guest and new friend here, Devan Malhotra. He's a general partner at Valhalla Ventures. So Devan, really excited to have you here, and thanks for making time for me. Really appreciate it.
Yeah, thanks, Joel. I'm super excited to be here.
Yeah, well, why don't we kick off with just a little more about, your firm, your background, and, how you got here. Just for background, Valhalla Ventures backs visionary founders building enduring moats. They mainly invest in seed to Series A and also in between. I've also done the same. And, Series A, seed, pre-seed, it's different terminology for different people, and different people have different constraints for what they describe it. So, excited to kind of see, how you look at those deals and kind of how you classify them, based out of Los Angeles. So excited to learn more. So why don't you kind of talk about your early career, maybe your education, and then how you got to where you are now.
Yeah, awesome. Thanks, Joel. I grew up in New York City. I'm a city kid. I went to the University of Pennsylvania, where I was lucky enough to be surrounded by people much smarter than I am. Was a mediocre student, skipping class and reading books in my free time, and always had a knack for building companies, and wanting to be involved with again, people much smarter than I, building at the forefront of industries. And that's really, in my opinion, what venture capital is. So went to Penn in Philly, and soon thereafter started a company, and got experience in the operating side. After Penn, and after being an operator, joined Madison Square Garden Company, MSG being the publicly traded entity that owns the Knicks, the Rangers, the Tao Group, et cetera. I primarily operated in new ventures under MSG, where I got exposure to a whole consortium of things. But really, MSG's guiding ethos is around entertainment, right? And that's entertainment in all forms. Owning the Knicks and the Rangers is one thing, but looking forward, what is the next iteration of entertainment? You obviously have what we covered a lot at MSG Ventures, was on the gaming, real money gaming, consumer social side of things. But also now, you have the Sphere in Las Vegas, which is one of the most amazing pieces of property, and one of the most amazing, I think, technological innovations that we've seen, at least in terms of stadium hardware, over the last few decades. And so I got to have exposure to all these things, and was lucky enough to be a part of a few amazing projects at MSG, and work with some amazing folks, and really get exposure to, within a big company, kind of that fast moving energy of new enterprises and new ventures. Thought about what was next for my career, and got the idea kind of popped to my head by a friend around what a new venture fund would look like. And I kind of hemmed and hawed a little bit, to be quite honest with you. I think that there's a lot of venture funds that do the same thing kind of time and time again. And so, ideated on it for about a year, maybe two. But really, our guiding thesis at Valhalla was developed over the course of 2019, 2020, and 2021. We saw this massive boom in venture, right? Driven by a zero interest rate phenomenon world, where we saw money flowing into, venture at an unprecedented rate, but really seeing it flow into spaces that we thought largely were incremental changes, and not massive step changes. And so as we looked at the venture ecosystem, the last 20, 25 years of venture returns have largely been driven by software returns, right? And we think that's for two different reasons. One, software has allowed for this massive new distribution with high margins, but more importantly, almost, software has historically been very, very hard to create. And so the best and brightest minds, starting on Sand Hill Road in Silicon Valley in the 1960s, physicists, chemists, biologists moved from those hard science spaces into being computer scientists. and as a result, built the businesses that we know of today as the greatest businesses of the world, right? Apple,
Yeah.
Nvidia, Amazon, et cetera, et cetera. But the fact of the matter is 5-10 years ago, that actually started shifting back to the point where we saw software as not only easy to create with the rise of low code, no code businesses, but now actually as somewhat of a commodity. And I say this with a touch of vanity as a non-technical person myself. But we largely think that there are very few moats that exist in the software space right now, in pure B2B enterprise software right now, as a result of software becoming quite easy to make. And
Sure.
I think it's a surprise to many in venture that this is actually reflected pretty deeply in public data. So there's about 80 companies created over the last 20 years that are B2B enterprise businesses that are over $1 billion in market cap. 75% of those businesses, and those are enterprise software businesses, 75% of those businesses have negative operating margins, and only 2 of those businesses have operating margins above 10%. And so our consensus is that actually we've been fed this, I wouldn't call it a lie, but we've been fed this tale that software is the only place to actually create real alpha within venture. And the fact of the matter is all of the data shows that that's not true. And if you look at the flip side, there's about 40 companies that are publicly traded that are what we consider physical technology companies created over the last 20 years. 75% of them have positive operating margins, and about a third of them have operating margins above 10%. And so we took this data and we played around over 2020 and 2021 with a series of SPVs to kind of build out this thesis. But really, to your kind of introduction, and thank you for that, where are the biggest enduring moats over the next 10 to 20 years within venture capital? And we think they exist in kind of 2 unique realms. One is in the world of physical technology and physical engineering and that talent pool. And so that's for us, bio, energy, materials, manufacturing, space, air, defense. And then the second is in the world of IP, right? So that's for us, therapeutics and also gaming, given my background in MSG. And so, kind of bringing together, all my experience, at MSG, kind of having exposure to the gaming side, but also the sphere side, and then doing a deep dive on really where we believe that those moats exist over the next 10 to 20 years. That's where we've settled. So we raised Fund 1 at the end of 2021. It's a $66 million fund. We write $2 million checks really only at seed plus and off cycle. And I'm happy to dive into more of what that actually looks like. And we're about halfway through that fund right now. And I think, we've seen now kind of the writing on the wall. I think a lot of folks are now flowing into our spaces, which has made the fund perform quite well, which is exciting. And we've seen, some nice marks as a result of a lot of money flowing into hardware and into deep tech. And also we have all of these tailwinds at play too, right? We have, things, like the Build Back Better Act, like the Infrastructure Act, all the movement around onshoring and nearshoring that has played a really heavy hand in terms of where venture we think is going. But that's largely what drives us, right? Where are we rebuilding, both the physical world and the world of IP over the next 10 to 20 years? And as a result, how do we create alpha there?
Yeah, no, that's helpful. Well, I got a question for you that's a little unrelated to the investment practice, but how was it like, growing up in New York? I'm raising kids right now in New York City. So what's your opinion, despite what everybody else says, in terms of just being raised or raising families in the city? And now you live in LA, so I'm not sure if there's any strong opinions around that.
Yeah, listen, I mean, I get the question a lot, right? Because everyone lives in New York, but is anyone really from New York? And I think I'm one of the few people from New York. I think that growing up in New York, I didn't know any different, right? I was an 8, 9, 10-year-old, right? So I didn't really know that there was a whole other world that exists out there. I think growing up in New York has massive pros and big cons, right? I think that for me, it was the perfect place to grow up, just because son of an immigrant father and an nth generation American mother. And so it was a perfect kind of melting pot for us. I got exposure to the amazing hustle culture that is New York, and also all of the different beautiful, cultural inputs that New York has, right? The food, the shows, the art. It's it really, what the Bob Dylan quote, right? The center of the capital of the universe, right? And it really is the capital of the universe.
It
I mean,
is,
even as as you said, having lived outside New York now for a while, right? It draws you back in. You feel that that pull, like the sun, that New York has, right?
Yeah.
And even if you go to London, you go to Tokyo, you go to Beijing, like I don't know that any place really can touch New York these days. And so it really still is the capital of the universe. I mean, I think that for us, California and Los Angeles has played a really pivotal role in terms of our development as a firm. And I do believe that in terms of startup innovation, California still is Mecca. But listen, I think there was a time, and I'm sure your kids will go through this as well, where they, really embraced New York, where they detested it and, needed to get out. But I think it always draws you back in. There's something special about New York. And I think it's a really amazing amalgamation of different cultures. And also, I think it's uniquely the only walkable city, or one of very few walkable cities in the US. So you have that beauty of happenstance that happens a lot in Europe, but you have the American innovation on top of that, which I think is a very, very special mix.
Sure. What are the cons? I'm assuming space is one of them, right?
Yeah, I mean, I think space, cost. I think we were lucky as kids that our parents forced us to try to develop more real world attributes. But I do think I often run into friends of New York, myself certainly included, that because ordering in is so easy. So kids sometimes don't know how to cook, or doing basic things like fixing a car, like changing car oil or things like that. I think those skill sets for kids in New York certainly fall through the cracks at some level. And then I think one thing that I've loved about being in LA is part of the underbelly of New York is that you think only New York exists, right? Because it is the capital of the universe. It feels like only New York exists. And so as a result, I think that, it's good to get out there and realize that there's more out there, while also knowing that New York will always be home. So, but, I think, all the things they say about New York are true, right? It's too small. I mean, you don't have enough room. It's, you don't have enough money. But those are the sacrifices people make to live in New York.
Yeah, no, absolutely. I mean, I think for me, two kids. I mean, I think the pros are that, I think these are the pros that I see, right? So I live in Midtown, so it's easy to, drop your kids off if the school is nearby. Obviously, there's some people who go to private school where like their school is really far away, or they got to take they go to like a gifted school and they got to take a school bus. So I think logistically, sometimes there's benefits. A lot of events are in Midtown, and then I feel like the cocktail events, or like the networking events, the cool ones are like in the Lower East Side, which are both either walking distance or just like a really quick Uber ride away. But you're right, you don't get the space, right? So you don't get like the picket fence in the backyard that you would if you lived in Jersey, or like the suburbs. So I think that's kind of the pros and cons that I see. But I totally agree with you, and I think the ecosystem here is very unique. And then I think what's exciting is if you have a platform, the entire platform becomes the culture and the ecosystem, right? So our fund accelerator that we have graduates that have come from. There was one guy from the Bronx that has launched the fund in Southeast Asia. And he'd been living in Singapore for the last 10 years, but he flew up to New York for some event and I met him. So I think the cool thing about like LA, San Francisco, New York is people will ping you if they're in town and maybe you never met them at all in person. Right. So, I mean, I just, when I was in SF last week, I mean, there's probably at least close to 100 people that I just met for the first time after knowing them over Zoom for the last 4 years, so just kind of really finding that connection point is agnostic of your region. I think if you've done a good job building a good community, in my opinion, I feel.
No, I completely agree, and I think New York is proven to be a really special breeding ground
Hmm.
for startups that has, I mean, been built in the trenches for a long
Hmm.
time by folks
Yeah.
that kind of were in the know, but is certainly a force to be reckoned with now. And my partner Rohan lives in New York, my business
Hmm.
partner, and I mean he's a big believer in the New York ecosystem, and then you have folks that have been building it for a long time. I mean, some of the best funds in the world. You're at the USVs. I mean, Fred and Andy and Albert have done to bring New York up to speed. I mean, our friends at ENIAC Ventures have invested heavily in New York, and I certainly I think New York, especially for some very specific sectors,
Hmm.
is a force to be reckoned with in the startup ecosystem
Yeah.
that folks
Hmm.
did not expect, even 5 years ago.
Hmm. No, I totally agree. What advice would you give for people that are looking to start their first fund? And tell me about the whole ideation process. Like, how did you decide to finally burn the boat and say, look, I'm going to launch a fund? And then what's some advice that you give for people that are just starting to think about that process?
Yeah, I think that I two questions there, but I think that when we started the fund originally, we started as kind of a deal by deal SPV, aggregator, and we were lucky enough to get into some great deals and to ride the coattails of those great deals, and to also um, you know raise our capital at a time in
Mhm.
which capital was generally easier to raise.
Yeah.
I think my aha moment was that uh, the deal by deal SPV route is great in some capacities, but I think
Hmm.
it falls short in terms of what I wanted to accomplish, which was
Yeah.
being at the forefront of innovative companies at their earliest, or alongside their earliest journeys.
Hmm.
And
Yeah.
venture capital at its core, even more so today than it was 5 years ago, is a power law industry, right? In which you
Hmm.
need to have those few breakout winners for it to make sense, right? And
Hmm.
I forget the exact data, but there's basically 5 companies a year that you need to be in the mix in, right? Within the
Yeah.
early stages, right? And so we soon realized that, hey, we're getting into great deals on the SPV side, but it's actually not at our core what we want to do and what we want to be a part of. We want to be a part of supporting founders at the earliest stages of what they do, right? And to do so, we think you need to have some sort of fund model that, one, allows for you to take that risk to get that upside, because
Hmm.
you have a fund model that protects the downside risk of your LPs, right? If you're investing
Yeah.
in pre-seed and seed and Series A companies with deal by deal LP capital, the downside risk is fairly significant, right? Because if they don't invest in every deal, they could have 6, 7, 8 deals that end up going to zero, when that one deal that they didn't do is the 1,000xer, right? And
Yeah.
so for us, we thought that was very important, and we
Hmm.
were able to parlay our success in the SPV route to be able to raise a nice size fund one. I
Yeah.
would say, listen, I'm not in the business of giving giving advice as a sub 30-year-old still in this
Sure.
industry. But I think that where we have been uh, successful, and kudos to my partner Rohan, as he's built a lot of this thesis out,
Hmm.
is I think the old adages of venture are still quite true. I think that concentration is key. We are big believers in having a fairly concentrated fund. So this fund will be about 20 to 22, maybe a little less than that, core investments.
Yeah.
And I think that that allows for us to have enough ownership, work hand in hand with teams in a
Hmm.
way where we're boots on the ground with them. We take board observer roles and board seat roles, but also allowing for us to have enough breadth and enough
Hmm.
diversity. So I think
Yeah.
that that's one very core learning that I would share on with other other investors.
Hmm.
And then the second thing is, I think as our thesis is developed around the world of physical technology, is listen, I think that largely uh, uh, sector specificity within venture is a ploy to bring around LPs, right?
Yeah.
It is the best funds to ever exist. First, have been generalist funds, and two, have been funds that invest in what we're calling enduring moats. But whatever you want to call them, right? Blue oceans, monopolies in some capacity, right? The best funds to ever exist haven't said, oh, we only invest in construction tech or we only invest in fintech, because there's, again, it's a power law industry. There's very few deals every year that are actually returning your fund many times over, right? So we think that, I guess the advice I would pass on is, find what those enduring moats exist to you, and where you can actually find edge in getting into those deals and or seeing those deals early, right? And so I think saying, hey, I have built my entire career in, whatever it is, right? Gaming. And so I'm only going to do gaming deals. I think that has a ceiling, right? And so I would advise folks to say, okay, within gaming, how do you take your knowledge base and parlay that into, XYZ, right? I mean, even Mitch Lasky, right, who is the godfather of modern day gaming venture investing. Even Mitch, who leads who has historically led all of Benchmark's gaming deals, he does a deal or two a year, right, in the gaming space, because he recognizes that there's if there are 5 companies a year that are hitting that $10 billion market cap point, that the likelihood of them, more than 1 or 2 of them being gaming, is quite low, right? And so he's thus expanded his capability elsewhere as well. So I would say concentration and sticking to your guns is quite important. And then for us, something that's been hugely valuable, I think, given the fund our size, has been our entry point and where we're investing at seed plus. And so I think finding that edge too is going to be important.
Sure. What are some ways that you can differentiate yourself, I guess, as advice to fund managers, because there's so many funds focused on gaming, so many funds focused on SaaS, AI, right? I mean, one thing I've seen with AI is I've seen subsector granular specialization. So I've seen somebody just launch a fund specifically on AI copilots, which I thought was pretty interesting. So what are your thoughts on that? Do you think that helps, or are there other things that you can do in terms of storytelling, in terms of brand building, in terms of business development opportunities, or just business development activities, right? Is it a volume game? I guess, any advice you have on those points?
Yeah. So I think, to reiterate the kind of point I just said a little bit and tweak it, is I think the best way to differentiate yourself is to get into good deals. And that sounds like almost pejorative, but it's true, right? Like I think that saying, hey, I only focus on AI copilots, or I'm the biggest, podcaster in XYZ space, that can only take you so far. And I think that in this case, launching a new fund and being able to be a little more patient is going to be key. I mean, you look at Chris Sacca's fund run one, right? It was a $7 million fund, and it had Twitter and Uber. And as a result of that, he became Chris Sacca, right? He didn't become Chris Sacca by saying, I'm going to invest in software companies in Silicon Valley and then branding himself like that, right? He's Chris Sacca because he got his fund one was whatever it was, 1,000x, I don't know, and that's how he became Chris Sacca, right? And so I think that as we think about our differentiating factor, as I said, we're going to be a hardware first fund, right? But that's largely because we think that the best companies over the next 10 to 20 years are largely going to be in hardware. And we're going to have gaming exposure because we believe that IP creation over the next 10 to 20 years is going to be, where a lot of alpha is going to be created within the entertainment space and now within broader software. And so I think that, the answer to that is get as much ownership as you can in good companies. And that sounds way more simple than it should. We're not hugely active on, being a promotional firm. Maybe we should be more active. And obviously I'm on this podcast now. We have a very, core group of LPs that we've worked with now for quite a bit, half a decade, that trust us and kind of see in us that we're, sticking to our guns. And then on the flip side, we have a very small group of founders that we work with hand in hand on a day-to-day basis. And I think that as a result of that, we've been able to show marks and to get into good deals. And that's all to say that we're still, learning new things every day and, get punched in the face every day doing so. But I think, differentiation is largely, a ploy to get LPs in early. And if you're optimizing for medium and long-term success, the best success is always to get high concentration in the best deals possible.
Sure. When you say high concentration, do you think what are your thoughts on a high conviction concentrated portfolio versus a more diversified portfolio? What I think is, obviously, if you're highly concentrated, you're making like 12 bets, right? Those are highly super high conviction. You're betting. I'm assuming you're thinking each of those deals. You have so much conviction. Hopefully, each of those deals you believe that they'll return the fund, right? That's how much high conviction you have.
Yeah.
But any thoughts on that in terms of like both strategies?
Yeah, I mean, I'm a huge believer in high conviction and high concentration, to the point of like, a little bit of danger. You don't want to, tip too far over, but I think that having a, high concentration and high conviction fund is where you see real, real alpha created. And I think actually the only way to actually have those massive venture style returns. I mean, if you look at like a 3x fund over 10 years right now, that's a 12% IRR a year, which compared to the NASDAQ is terrible. And so really what you have to do is and 3x fund, if you told any early stage manager that, they'd be like, awesome, I'm great.
Yeah.
Because very few folks actually can hit that. And so you actually have to be shooting quite a bit higher than that. And to do so, I think you have to have significant ownership in your winners to be able to actually get there, right? So this fund, as I said, will be 20 to 25 core investments. I think actually, so we'll go out and raise fund 2 at the end of 24, early 25, and we'll probably target less than 15 core investments for fund 2. Just because that's something we've learned along the course of this fund. So we'll try to be even more targeted. There's hearsay and rumors out there that, Founders Fund 3, their third fund had, a third of their fund in Palantir, right? And I think that, Peter is probably the preeminent example of saying, hey, we take, big shots on our winners, right? And I mean, I think if you look at over the data stack of who are the best funds that we think of when we think of, returns, Benchmark is a perfect example, right? Benchmark raises $300 to $400 million funds, and they only write Series A 20% lead checks, right? That's all they do. And they don't hold for follow-on reserve capital. They buy 20% up front so that by the time the company exits, they'll have about 10% of the company. And they do that, so say they raise a $300 million fund, that'll be $60 million or so in management fees. So say they have about 200-ish to invest, that's about 20 investments for them, right? So they're fairly concentrated. And I think that that's really, especially in today's day and age, where we're seeing kind of companies fall by the wayside every day, and the winners really take off. I think that that's the only way to generate an amazing fund these days.
Yeah, no, I totally agree. I noticed that you've invested in a handful of space companies as well. So you've invested in large satellites, small satellites, and also lunar refueling. And I've also invested in space tech as well. So what are some of the things that you're looking for in terms of standout, satellite companies? And then I think I saw a few in space refueling companies as well. What were some kind of unique things that you saw with those companies you invested in? Then where do you see the trends in space as a whole heading in general? Like, I mean, the launch sector, I noticed you didn't invest in launch. I'm not sure if you feel that that's kind of a crowded or risky area, but yeah, would love maybe some trends on space, and then maybe I can go to your other deals in your portfolio, maybe just talk about those two. But I think the space was kind of interesting.
Yeah, absolutely. So space is an area that we think, I mean, he's a controversial figure in many circles, but I mean, Elon Musk has really, commercialized an entire industry that is a multi-trillion-dollar industry, right? And I think a lot of the revolutions and that we're seeing now that are going to be off the backs of SpaceX taking the lead, right? In terms of how we think about space, we think about things generally in conjunction with SpaceX. So where is SpaceX not building? Where is there a white space to own? And what has been made possible now as a result of SpaceX, right? I think K2 is a perfect example. We invested in the seed plus of K2 in June 2023, and the company has absolutely gone haywire since, or they were starting to go haywire, before that. It's founded by two brothers, one a former SpaceX engineer and one was a consultant at BCG, and they had a concept that the large bus satellites that are created by Raytheon and Lockheed can be done much cheaper and much more efficiently. And they've proven that out in spades. And so we invested, as I said, in their seed plus. They raised a $50 million Series A led by Altimeter in December of 2023. And they're currently in the process of negotiating some massive contracts. And we think that this is largely only possible in a post-Starship, post-Falcon 9 world, right? And I think if you look at a lot of the progression that we're going to see in space, it follows the same, the same story, right? Where we see things that are available and see things that are possible now in a kind of post-commercial, post-SpaceX world, right? And so that is really a kind of, and where SpaceX is not going after, right? So that's a really big thesis by which we invest. It also comes down to talent, right? I think, if you look at, the teams that are able to, and part of the reason we love being in Southern California, the teams that are able to draw from the SpaceX ecosystem, and what Southern California has, and this kind of El Segundo, renaissance that's going on right now, that we've seen is folks being able to draw talent from the SpaceX ecosystem and everything that's going on in the South Bay. And so it's been pretty amazing to be a part of, and we're really excited about our space investments. I'd say we think that there, like in any industry, are a few areas that are interesting rather than kind of the full gamut. To your question, right? We don't think a launch is an area that is going to be really viable for anyone in the startup space, just because we think SpaceX owns the entire ecosystem, and has largely created a monopoly at this point. But I think that there is ample room across the stack for us to generate huge returns.
Yeah, no, I totally agree. Let's see what else you got here. So you've got some gaming, and you've got, let me see what else I thought was interesting too. I think, wow, firefighting helicopters. That's really interesting too. So tell me about that one, and then also the DNA chips.
Yeah, so I'll tap out of the DNA chip company because that was led by Rohan, who's much more integrated in the biospace than I am. But yeah, so Rain is a company that we invested in just earlier this year. They are doing autonomous firefighting helicopters. And so they're able to adapt military and civil autonomous aircrafts with the intelligence to perceive, understand, and suppress wildfire fires in a fraction of how they're able to do so right now. And so, currently fighting wildfire fires is extremely dangerous. takes a lot of manpower. And what Rain is doing is they're adapting existing Blackhawks that are already autonomous, with ability to detect fire early, to then enable aircraft response and then contain that fire. And so the way it works is kind of that 3-step process where, you have regional early wildfire detection sensors that look for, smoke, lightning, things of that, ilk, especially in the American West. So, looking at California, Idaho, Nevada, Washington, et cetera, et cetera. Then there is going to be a Rain-equipped autonomous helicopter that launches and flies to the coordinates relayed by these sensors. And they will perceive the fire, understand its behavior, size, direction, and spread, and then use that information to design a suppression strategy. And then the software on the aircraft is able to deploy fire retardant while Rain's wildfire intelligence system builds a strategy that considers a subsequent responding aircraft, incorporates their resource and arrival time into an optimal suppression strategy, and then there are obviously communicating at all times with ground crews, right? So it's a pretty amazing thing that the team is building. We're in that Seed Plus round that was alongside DBL Partners, Nancy Fund, who's an amazing person to be investing alongside. And Rohan, my partner, sits on their board with alongside Nancy there. But an amazing team that's based in Northern California, and solving a huge issue. And not only they'll able to go after a big issue in terms of saving lives, but really the business applications here are pretty outstanding. You look at the amount of money that California spends every year on insurance, right? And being able to bring that number down by a significant portion while not risking lives in the process, and given the current technology that Rain is adopting, is pretty amazing.
Sure. It's interesting. And I was also looking at the company WOMP. What I feel is there's going to be a big market for the Canva of X. So it looks like there's a lot of easy, intuitive interfaces for kind of doing 3D modeling, and there's probably some other tools out there. I wanted to kind of 3D print like a toy and ship it, but I couldn't figure out how to do it. I actually watched the YouTube video, and it looked really complicated. You have to go into CAD and design it, and there's all these complex parameters. Where with Canva, you can easily just kind of put together a deck or design really cool social media art. And then I recently saw, so now on TikTok, there's a lot of cool content where you see these startup pitches, and founders will pitch a VC in a minute. So there was this really interesting founder. I forgot the name of it. I got to go maybe scroll back up, but there was a company that that does Canva for gaming. So obviously, right, if you want to launch a game, you got to go into iOS and deploy a gaming app, or you got to hire developers. But she pretty much built this software that can help you author games, and then I think you can create all the logic, create the characters, and then ship it, I believe, to different devices. But I think she was saying they're at 500K in revenue year one or two. So I thought that was really impressive. So I think just kind of the Canva of X. I think also there needs to be some type of Canva for video editing, because even right now, if you want to do video editing, you still need an editor to go in and kind of crop everything and completely do all of this manually. There's probably some AI applications that can automate some of that. I've played with a few of them, but I truly believe there's opportunity to kind of just make this workflow just super easy, right? What you see is what you get.
Yeah. And so, completely agree. And I think that WOMP is taking a really amazing approach to doing just that, right? They're essentially creating, Blender, but, Canva style, right? And being able to make 3D assets, purely using the web, right? And I think it's a huge, there's a huge capability here, to your point, in both 3D printing, right? If you can design, 3D design software on the web, any normal guy, right? Blender takes, a year to learn, right? It's a fairly complex software. Whereas, WOMP, you can do the same thing, in a matter of minutes, right? And get your projects 3D printed at home, create thousands of assets to be able to drop into any of your creations. And extremely, extremely easy to learn, right? And we've also seen a huge value in the ability for them to look at gaming assets, right? I think one of the big barriers to entry to creating games over the last 2 decades has been it's been really hard to create assets, right? You need computer scientists that are trained at the utmost level to be able to create 3D assets, and this solves this huge problem there, right? And so I completely agree with you. They're an awesome team based in the Bay Area. Browser based, allowing it to work on all devices without the need for as I said, high end training. And I think one thing that they've done really well is you own your assets, right? So it's once you create any WOMP asset, it's yours. And so folks have already started using their assets across all sorts of different asset classes, which we think has been pretty amazing. And they'll go out and raise a Series A later this year, which we're obviously pretty excited to see. And they have some crazy statistic. I mean, they've created I think they're creating now 10,000 assets a month or something like, it's pretty amazing.
Yeah, no, that's amazing. And then let me see, we'll do one more. So gaming, so I think you got some sports media and then you got, these board games. What's your high level thesis on just kind of the gaming space?
Yeah, so gaming's going through a bit of a rocky era right now. There's been huge layoffs at Blizzard and Activision, and I think as I said, about 80-90% of our portfolio will be in this kind of hard tech, deep tech area. But gaming is something that I lead within our firm and something that's very near and dear to my heart, and something that I'm very focused on. I think if you look at the gaming ecosystem and I think our thesis as a whole is, where is there going to be, alpha that's going to be created in gaming? I think that if you look at 2009 to 2014, you saw the rise of mobile, and that allowed for huge, exits within the gaming space, right? Mobile was high barrier to entry because of the creativity levels, but was massive distribution with big margins, right? IDFA killed that to some extent with Apple's new regulations. We have the ongoing Epic lawsuit, and so the question then becomes, okay, where is there going to be opportunity within gaming over the next decade or two? And the two areas that I love and that I spend the most time in are, one, what we call capital efficient IP. So, while gaming IP is historically very lucrative, backing AAA studios is extremely capital intensive and makes little sense from a venture perspective, right? We've seen companies in the States raise anywhere from $50 to $200 million before ever getting a game launched and validated. And so our focus is to look at often overlooked or even entirely novel mediums of IP generation, right? In the former category, we've made an investment in the tabletop space. So that company that you mentioned, Incredible Dream. And what Jane's thesis is, I sit on her board, is she, was a spin out of Riot Games. She said, hey, I think there's a huge white space to essentially create a platform level approach to creating IP. You can raise, $2 to $5 million and you can release X amount of IPs. Those IPs that you create successfully in the tabletop space, you can then scale digitally into more scalable mediums and then more profitable mediums after that, right? Movies, television combined. And that's exactly what she's done, right? So she's now released 5 IPs over the course of the last year and a half since we've invested, which have put her on the brink of profitability. She is now scaling that IP into digital, and then soon thereafter we'll scale into more profitable mediums that look like more classic video games, movies, etc. Right? And so I think that is one area. How do you basically recreate what happened in mobile with current day technology, right? And then I think the second thing is where you're creating fast iterative IP and then scaling it. The second thing that we like and we spend a lot of time in is real money, competitive platforms, right? And specifically verticalized real money and competitive platforms, right? That own their own IP, right? So one of the companies that we've invested in is a company called 1v1me that's doing staking for you won't find it on there yet, but it's doing staking for competitive gamers. So, it takes the playbook of old poker players. So, any poker player would go into the World Series of Poker. He or she would raise money from their fans, put it up, and then you would get a pro rata way of owning of your distribution, right? And what that allows for is a few different things. One, it works around current day gaming and gambling. Oh, there's a thumbs up. It works around current day gaming and gambling regulations. Two, they own all of their IP because it's verticalized. So the way in which 1v1me works is any gamer logs onto the site. They have a series of matches every day, and you put your money on whatever gamer you think is going to win in that stream. And you get paid back. And the amazing thing about owning all your IP is you basically capture 100% of GMV as a result. And we've seen, I think, a huge movement towards real money and towards pick'ems and things like that across the entire space. And we only think it's going to get bigger, with the mass adoption of mobile in Asia, with deregulation across the globe when it comes to betting and real money gaming. And so within gaming, those are the two areas we spend the most time.
Yeah, no, it's exciting. Well, hey, I really appreciate all of the insights. Maybe you could give us a few more nuggets on Los Angeles, just kind of some of the observations that you're seeing with that ecosystem. I met some amazing managers and LPs from LA. Obviously, the Milken, Institute. They do their events every May in LA. So there's definitely a huge, robust community there. But and the food is awesome there too. But any other just high level insights that you're seeing in terms of just the community developing, the tech VC ecosystem, the LP ecosystem?
Yeah, we think that LA is a really special ecosystem. I think that for us particularly, it makes a lot of sense. I mean, we only do hardware and gaming, and that just so happens to be where LA is number one in both. I think that we've seen, there was actually a really interesting article that you should check out yesterday, released about Mark Schuster, who's the founder of Upfront, I think calling him the godfather of LA venture capital. But we've seen the ecosystem maturing, I think, over the last decade to the point where it certainly is a major player at this point, especially I think in the arenas we operate in. I think within the hardware deep tech ecosystem, as I mentioned, you have everything that's spun up around SpaceX. And SpaceX is actually the Gen 2 of that, right? The Gen 1 is actually post World War II industrial Boeing, Lockheed, Raytheon, that really has become a result of a lot of these refineries that have been in Southern California for a long time, right? People talk a lot about the El Segundo ecosystem right now. El Segundo is the second. It's talking about the second refinery, right? That was in, right on that beach line near Manhattan Beach, right? And so the LA ecosystem on the hardware side has kind of really sprung from that, right? You have everything that's come from Anduril. You have everything that's come from SpaceX. You have this real genesis going on around hardware. And then subsequently also on the gaming side, right? I think everything that's spun out of entertainment, in the 30s, 40s, 50s into what became the gaming ecosystem, Activision, Blizzard, Riot, all of these companies have been headquartered in LA forever. And now you have, what is the Gen 3 of that coming out of that, right? And then I think on top of that, at the end of the day, capital's great, but talent is more important. So you have, you do have, places like UCLA, places like USC, Caltech, that are, giving, this amazing talent to the ecosystem, free. They're just flowing in there after the university. And so it has, I think it still pales in comparison to SF. and certainly, is a third fiddle behind New York as well. But there is a really amazing ecosystem here that is growing day by day, and it doesn't hurt for founders when they're banging their heads against the wall to wake up and it's 75 and sunny every day.
Yeah, no, absolutely. No, that's exciting.
But
Well, I mean,
you obviously have, Andreessen opening up a big presence here. You have,
yeah.
you have the kind of hardcore hitters who have been here for a long time, left the upfronts. But it's becoming a place to be for sure.
Yeah, no, absolutely. Well, thanks so much for all the time, Devan. I know you spent a lot of time really just unpacking several topics, right? Living in New York, different sectors that you're investing in, along with more granular details, along with just different ecosystems. So excited to continue the friendship, and thanks for sharing your story with the community. And hopefully, I see you back home in New York at some point.
Absolutely, man.
Yeah, take care, man. Have a good one.
Awesome. See you, Joel.
All right, see you. Bye.